Okay, let's have a look at this example with some numbers behind it. So we're going to assume that A has taken a 100% ownership stake in C, so they have definitely gained control and they own all outstanding equity of C. The consideration that they paid for that, let's just say it was $10 million. And we're going to say the fair value of the identifiable net assets was also $10. So they're paying market rate for it. From this point in time, we're going to have a look again at the transactions that we actually see occur. So in A's books, what we see happen is debit investment 10, credit cash 10, and in C's books nothing occurs. What's also then really useful to do is look at the balance sheets of both companies once the transaction has already occurred. So for company A, the parent, we have cash sitting on the balance sheet of $5 and they have an investment of 10, giving you $15 or $15 million of assets and capital of 15. So they've got shareholders capital of 15 and everything balances out. For C, C's balance sheet looks like so. They've got cash of $10 million and that's it. That's all they are. They're literally just a pile of cash sitting in this company. And they have capital, so shareholders capital of $10. So we should put in the total of the assets. And so we now have the two balance sheets. Now part of what AASB 10 basically requires companies to do is to say if they're part of this group and they have to create consolidated financial statements, is to aggregate all of these items. So if we were to do that and just aggregate across, what we'll end up with is cash of 15, an investment of 10, giving you assets of 25, and capital of 25. So that's purely if we were going to just take them straight across like that. Now, there is a little bit of a problem with this, and this problem exhibits in two places. The first is capital. So what we're seeing here is a capital number of 25. However, the only external capital holders are the equity holders of the parent, because this capital of 10 is actually owned by the parent, so it's actually within the group. There is not $25 million of external equity holders. So this is actually overstated by this capital amount here. So in essence, we almost need to get rid of that. In addition, this investment amount here is overstated, because what that's picking up is the investment of A in C. But if we see the group investment, the group has an investment of 10, that's saying the group, which is this, has some sort of outside investment, and it doesn't have that. So I'm just going to get rid of that for a second. So this investment, in a sense, doesn't really exist because it's not an external investment, and we, in a way, need to get rid of that. And so without actually doing the entries at this point in time, we can see what we should end up with is cash of 15, because even though it's in two places, that cash actually does exist. We have zero investment, giving you total assets of the group of 15, and giving you total equity in the group of 15. And that is the group in its essence. And what we'll look at in the next video is how we do the adjustments and some of the details around the adjustments that need to be made.